Welcome to TalkTickers, your go-to deep dive into the heart of earnings calls. Today we're breaking down Amer Sports' second quarter results for fiscal 25. We've got the earnings call transcript from August 19th right here. Our mission, like always, is to cut through the jargon, pull out the really critical insights, and help you quickly understand what's really driving this global sports and outdoor giant. And we've got a bit of a puzzle today, actually, because Amer Sports delivered what, on paper looks like a stellar Q2. They beat analyst expectations, top and bottom line. But the market's initial take, surprisingly cautious. So that's what we're digging into, the strong numbers versus that kind of muted investor reaction. What's going on?
That's exactly it. It's a fascinating contrast. So, okay, let's hit those headline numbers first. Amer Sports GAAP EPS, that's the official earnings per share, came in at 0.3. Adjusted EPS hit 0.6 cents. Now, that significantly beat the Zacks consensus, which was pegged at just 0.2 cents. So a solid beat there. Okay,
0 is adjusted versus 0.2 cents expected. That's quite a difference. What about revenue?
Revenue was also really strong. It reached $236.3 million. That's a robust 23% jump year over year. And it also outpaced the consensus estimates by about 4%. So strong growth.
23% growth. That's impressive in this environment. Did that translate to better profitability? What did the margins look like?
Yeah, margins expanded nicely too. The gross margin was up 270 basis points, hitting 58.5%. That's, a 2.7 percentage point increase, which is very healthy. Adjusted gross margin also climbed to 58.7%, up 250 basis points.
Okay, good. And operating margin?
Adjusted operating margin also saw a notable increase. It was up 260 basis points to 5.5%. Now, it's worth pointing out that did include about a 150 basis point benefit from $19 million in government grants they received. Right,
so a bit of a boost there, but still showing underlying improvement. So we've got growth, we've got better margins. Where did this growth actually come from? Can we break down sales by channel and the different business segments?
Absolutely. The direct-to-consumer channel, their DTC business, was really the engine here. It surged 40% year over year, hitting $640.9 million.
40% DTC growth. Wow.
Yeah, massive. Wholesale grew too, but more modestly, up 9% to about $595 million. Segment-wise, outdoor performance, think Arcteryx here, that led the pack. Huge growth, up 35% to $414 million.
Okay.
Technical apparel, that segment grew solid 23% to $509 million. And then Ball and Racquet, Wilson, that was up 11% to $314 million.
So strong growth across the board, but really led by outdoor and DTC. Where was this happening geographically?
The regional story is really interesting. Growth was explosive in Greater China, up 42%.
42% in China.
Yeah, and the broader APAC region also up 45%. Just phenomenal growth there. EMEA, that's Europe, Middle East, Africa, saw a solid 18% increase. The Americas were, a bit slower, up 6%.
Okay, so Asia Pacific, particularly China, is a huge driver. What about the balance sheet? Debt. Inventory.
Net debt stood at $640 million. And inventories, this is a point we'll come back to, were up 29% year over year, sitting at nearly $1.6 billion.
Right. Inventories up 29%. That definitely catches the eye. We'll circle back. So, bottom line for the quarter. Definitely a beat and raise scenario on the numbers. Strong growth, margin expansion. But like we said up front, the market seemed hesitant. We saw the share price adjust downwards right after the announcement, and trading volume was much higher than usual. That tells you investors had some reservations, despite the shiny results. Okay, let's try and unpack that caution. Management spent a lot of time talking about their dual flywheel growth strategy. It's centered around Arcteryx and Salomon. Why are these two brands so critical right now? What makes them the flywheels?
It's a great question because they play different but complementary roles. Arcteryx is all about that premium positioning, the direct connection with consumers, and that almost cult-like following it has. It just keeps delivering. We saw 15% omni-channel comparable sales growth for Arcteryx. That's really strong on top of previous growth.
15% comp growth, okay.
And they're strategically expanding their stores. They added 7 net new ones in Q2, aiming for about 25 globally this fiscal year. They're really focusing on optimizing in Greater China, bigger stores, better locations, really curating that premium experience.
Makes sense.
And their product pipeline is performing exceptionally well. Footwear is doing great, but women's apparel is really exploding. Women's revenue was up over 30% in Q2. Specific items, like they mentioned, the Clarkia pant, are seeing huge growth.
Interesting focus on women's.
Absolutely. And a key strategic move here, they're acquiring Nelson Sports Inc. That's been their exclusive distributor for Arcteryx in Korea since 2001. They're bringing that entire Korean operation in-house in the second half of this year. It's about getting full brand control in a really key market.
Taking control in Korea.
Yeah.
Okay, that fits the premium DTC narrative. What about the other flywheel, Salomon? It feels like Salomon's breaking out beyond just trail running shoes lately. Is it really hitting the mainstream sneaker scene?
Oh, absolutely. Salomon's acceleration is remarkable, especially in footwear. Their DTC omni-channel comp sales were up 28%. Huge momentum.
28% for Salomon DTC. Wow.
Yeah. And they're pushing hard in Greater China, too, reaching 234 shops now, and they're on track for roughly 290 by the end of the year. What's key is the product. New launches like the XT Whisperer, the Airglide 3 running shoe with their new foam, even a gravel biking line called GRVL. They're consciously broadening the appeal from just hardcore performance athletes to, the everyday sports style consumer, the fashion crowd.
Right, leveraging that performance credibility for a wider audience.
Exactly. Management sees huge runway there across all major regions. They're explicitly aiming to grab a meaningful slice of the global sneaker market. It's a smart evolution.
The sneaker market potential is massive.
Yeah.
Okay, let's shift gears to the ball and racket segment. Wilson's the big name there. It grew 11%, which is decent, but management seemed to temper expectations for the long run. What's the story there?
Yeah. 11% growth is solid, driven by sportswear and obviously racket sports. Their Tennis 360 retail concept seems to be working well. They highlighted a win by a young Canadian athlete, Victoria Moko, using Wilson gear. They launched new Roger Federer collections. Their women's tennis shoe even got a nod from Women's Health magazine.
Some positive momentum.
Definitely. And they plan to open about 50 more of those Tennis 360 shops in China this year. But, and this is the key point management made, double-digit growth isn't sustainable long-term for this segment.
Why not?
They expect it to settle into more like low to mid-single-digit growth over time. It really comes down to the nature of the business. It's more equipment-based, less driven by fast fashion cycles than, say, Arcteryx footwear or apparel. Retailers tend to order more cautiously for equipment. So while Wilson is important and profitable, it's clear that the real hyper-growth drivers for Amer are Arcteryx and Salomon. That's where the bigger story is.
Okay, so Wilson's solid, but not the growth engine. And speaking of Wilson, there was some news on the leadership front.
Yes, that was another notable point. Joe Duty, who had been president and CEO of Wilson for 30 years, stepped down. That's a long tenure.
30 years, yeah.
So Amer Sports CFO, Andrew Page, has stepped in as interim president and CEO for Wilson and the whole ball and racket segment. He's doing both jobs for now.
Dual roles.
Right. They've launched a search for a permanent replacement. But, any leadership change, especially an interim one after such a long time, adds an element of uncertainty. It's something investors definitely notice, an execution watch item.
Understood. Okay, let's talk outlook. Management actually raised their guidance for the full year, which seems pretty confident given all the talk about macro headwinds and tariffs. What are the new numbers?
They did raise guidance quite significantly for fiscal 25. Revenue growth is now expected to be 20-21%. That's up from the previous range of 15-17%.
Big jump in revenue guidance.
Yeah. Gross margin outlook also raised, now expected around 57.5%, up from 56.5-57%. And operating margin is guided to 11.8-12.2%, up from 11.5-12%.
Okay, across the board improvements.
And earnings per share. Adjusted EPS is now projected between $0.77 and $0.82. That's up nicely from the prior $0.67 to $0.72 range. They also mentioned CapEx around $300 million and D&A around $350 million for the year.
So a confident outlook, Cliff. What about the current quarter, Q3?
For Q3 specifically, they're guiding for revenue growth around 20%, gross margin about 56.5%, and operating margin between 12-13%. EPS is expected at 20 cents and 22 cents. So continued strength expected in the near term, too.
Okay, now here's maybe one of those friction points for investors.
Yeah.
Tariffs. The guidance assumes the current situation, including that incremental 30% U.S. tariff on China, stays put. Management said they expect a negligible consolidated impact for the year. How realistic is that, given the noise around tariffs? Can they really mitigate it that effectively?
That's the million-dollar question, isn't it? And definitely something investors keyed in on. Management's confidence comes from a few things. One, pricing power, especially with premium brands like Arcteryx. They feel they can pass some costs on or absorb them. Two, their global footprint. They don't rely solely on China. Three, a strong balance sheet gives them flexibility.
Okay, so diversification and pricing power are key.
Right. But they did acknowledge the ball and racket segment will see a bit of a drag from tariffs in the second half. It's down to specific things like steel and aluminum tariff exemptions ending for Wilson, higher rates coming out of Vietnam than expected, and some unfortunate timing with temporary, very high tariffs hitting some soft goods from China.
So it's not zero impact, just managed overall.
Exactly. They believe that consolidated impact will be negligible thanks to the strength elsewhere, but there are definitely specific pressures within the business. It's a balancing act.
Another area that probably raised some eyebrows was that 29% jump in inventory year over year. That sounds like a lot. What was the explanation, and should we be worried about that pileup?
Yeah, a 29% increase is significant, and inventory can definitely be, a canary in the coal mine. But management offered a few reasons, mostly strategic. First, they brought in fall 2025 merchandise early, partly as a tariff mitigation tactic, get it in before potential changes.
Linked to the tariffs again.
Precisely. Second, they're using less air freight, which is expensive. That means more goods are simply in transit on ships for longer periods, bumping up the inventory number on the balance sheet. And third, there's an FX translation impact from the weaker US dollar, making inventory held overseas look larger in dollar terms.
Okay, so timing, transit, and FX. Not necessarily a demand issue then.
That's what management stressed. They feel comfortable with the quality of the inventory, especially for the hot brands like Arcteryx. They're saying it's not old stock they're stuck with, but rather strategic positioning. They expect inventory growth rates to get back to normal through 2026.
So framing it more as a strategic buffer and operational shift, not a demand warning.
Got it. And what are the key strategic investments driving all this growth they're guiding for? It really comes back to that dual flywheel. They're heavily investing in expanding their own DTC channel stores and online. Enhancing product innovation is huge, especially finding ways to appeal beyond core athletes. And strengthening their presence in key regions, particularly Asia, is paramount. That Arcteryx premium model plus Salomon's sneaker acceleration is all about scaling higher margin channels and deepening that Asian foothold.
Expanding the TAM, the total addressable market.
Exactly. Reaching those fashion-conscious urban consumers, not just the mountain climbers. They also signaled confidence in generating solid operating cash flow growth this year compared to 2024, which helps fund these investments.
Okay. And one last point from the call, there's an investor day coming up soon.
Yes, important date for the calendar, September 18th. In Vancouver, actually, at Arcteryx headquarters. The main focus is going to be on Arcteryx itself, its strategy, its opportunities. It's their first investor day, so it's a big chance for them to lay out the long-term vision, especially for their star brand.
Definitely one to watch. Okay, so let's try and tie this all together. We've got the strong results, the raised guidance, the strategic focus, but that initial cautious market reaction.
Right. It really highlights that divergence. You have the beat and raise headlines, management sounding pretty bullish, emphasizing growth across the board, but investors clearly latched onto potential risks.
So what were those specific points of apprehension that seemed to weigh more heavily than the positive numbers, at least initially?
I think it boils down to a few things we've touched on. One, that tariff overhang. Even with management's assurances, there's inherent uncertainty there, politically and economically. Investors hate uncertainty.
True.
Two, that 29% inventory increase, even with the explanations, it still raises questions for some about, how sustainable the demand really is, or if working capital is being tied up inefficiently.
Right, the show me factor on inventory normalization.
Exactly. Three, the leadership change at Wilson. It just introduces an execution question mark, even if it's temporary. And finally, maybe some broader questions about the long-term durability of that explosive China growth, just given the general macro picture there.
Okay, those are fair points of caution. So in that context, how does Amer Sports stack up against its peers right now? Are they uniquely positioned despite these concerns?
Well, the data shows the premium outdoor brands, Arcteryx and Salomon, are definitely continuing to outgrow most of their broader athletic apparel peers. Their brand heat and strategic focus seem to be differentiating factors. While the company's longer-term stock performance has been strong, this near-term market sentiment clearly reflects that caution around tariffs, inventory, and Wilson. Key things to watch going forward will be the Q3 results, obviously that September investor day for the deeper Arcteryx story, and then the holiday season, how those new product drops from Salomon and Arcteryx actually perform. That'll be a real test.
Okay, lots to track there. Now, before we get to our final segment, the usual but very important disclaimer. What we discuss here is not financial advice. It's purely for informational and educational purposes. You should always do your own research, your own due diligence, and absolutely consult with a qualified financial advisor before making any investment decisions.
Okay.
Okay.
Absolutely. So, with that very important caveat in mind, let's talk about an outrageous but plausible trade idea based on this divergence we've been discussing. Given the market's somewhat hesitant reaction despite the strong Q2 and raised guidance, one could consider taking a long position in Amer Sports shares, ticker AS. The bet here is on a fundamental re-rating of the stock.
Okay, going long AS, walk us through the rationale there. Why would the market re-rate it?
Well, the argument is that the market right now might be overly focused on what could prove to be short-term or transient factors. Take the inventory build. Management seems comfortable, has explanations tied to strategy and logistics, and expects it to normalize. If they're right, that concern fades. The tariff risk. Management claims a negligible consolidated impact thanks to mitigation like pricing power and their global footprint. If they navigate this successfully through the year, that risk premium might shrink.
Right.
And the Wilson leadership change. While a watch item, it's unlikely to fundamentally derail the powerful growth engines of Arcteryx and Salomon, which are much larger drivers of the overall business performance and valuation.
So the idea is the market is focusing on the noise, not the signal.
Kind of. Beneath that noise, you have these two incredibly strong, high-growth flywheel brands executing really well, especially in high-margin DTC and high-growth Asian markets. Management felt confident enough to raise guidance across the board while acknowledging the tariffs. That signals pretty strong underlying operational strength and pricing power. So this gap between the robust fundamentals and the immediate, somewhat anxious market sentiment that could present an opportunity for investors willing to look past the near-term worries and bet on the core strategy and continued outperformance.
Interesting. So betting that the flywheels ultimately overpower the short-term concerns. Okay, let's recap this deep dive then. Amer Sports delivered a really strong Q2. They beat estimates, raised full-year guidance, driven largely by powerhouse performances from Arcteryx and Salomon, especially in DTC in Asia. But the market's initial reaction was more tepid, seemingly focused on worries about inventory levels, the ongoing tariff situation, and that leadership change over at Wilson.
That's the picture. Despite that immediate reaction, though, the core story management is telling is one of successful strategic execution, the power of their premium brands, and a disciplined approach to capturing growth. The path forward seems clearly focused on more DTC expansion, pushing product innovation, and really leveraging their platform in key global markets, especially Asia.
Which leaves us with a final provocative thought for you to consider. In today's world, with information flying at us constantly and markets reacting instantly, how often do we let those short-term anxieties, that market noise, obscure what might be genuinely strong fundamental performance underneath? Something to think about. Remember, everything we discussed today is for educational purposes only, definitely not financial advice. For more deep dives into earnings calls and market insights, make sure you subscribe to TalkTickers. Thanks for joining us on this deep dive.